My name is David Goldstone. I manage investment research here at Condor Capital. As we're just getting rolling on third quarter earnings season here, now's a good time to look back at the year to date, what's been going on in the economy, and to look forward through the end of the year and into 2025. As we look to the end of 2024 and review the year to date, we continue to position our portfolios and clients for the future. Throughout the year, we've maintained our view that economic growth is moderating, but the economy remains healthy. The U.S. economy has shown remarkable performance since the pandemic. America's economy has grown by 10% since 2020, 3 times the pace of the rest of the G7 economies. The United States is still the foremost driver of innovation. The so-called Magnificent Seven companies are worth more than the entire stock markets of Britain, Canada, Germany, and Japan combined. American workers continue to make gains in productivity, tech companies continue to innovate, corporations continue to become more efficient, and consumers are continuing to spend. Zooming back from the day-to-day news cycle, both private and public companies have continued to successfully grow revenue and earnings. S&P companies grew earnings by 3.4% year over year and revenues by 4.7% in the third quarter. In 2025, analysts project those companies to grow earnings by 15% and revenues by 6%. Private companies tracked in the Condor Capital Wealth Management Index, which is an index of private companies, grew earnings by 8% and revenues by 5% year over year in the third quarter. Overall, companies are healthy and continue to grow. Looking forward, we are just a few days away from the election. Competitive elections add uncertainty to the market. Regardless of the outcome, moving past the election will provide clarity and certainty to both markets and companies, allowing investors and companies to prepare for the next administration. As we look to the Federal Reserve, we anticipate the Fed will take a measured approach when cutting rates. We anticipate rates to stay in the higher for longer for a little while yet. We do not think that the Fed is going to rapidly cut rates. Falling rates should provide relief to companies that borrow at floating rate debt, like the companies that borrow from the BDCs that we own in the BDC strategy. Consumers will get some relief on credit card rates. They'll also, as they go to make new large purchases on things like homes and cars, they'll be able to borrow at a lower rate, helping them to continue to spend in a robust way. It should also provide a tailwind for equities and bondholders, as investors will find less attractive rates in cash positions and may start to come off the sidelines in greater numbers. Now, it's worth noting that now is a great time to deploy cash, because once rates are fallen in money markets and other cash yielding vehicles, the benefit of the price appreciation that you get when rates come down and bond prices go up will be gone, and you will have missed that window of opportunity. So now is a pretty attractive time to be a bond investor, in our opinion. Declining rates will also help a variety of sectors. I think financials is one interesting one of note. Specifically banks, a normalized yield curve where the rates paid on longer term debt is higher than the rates paid on shorter term debt, help banks because they borrow at the short end of the curve and they lend at the long end of the curve, so it should help their interest margin. Also, we've seen really muted capital markets, meaning that mergers and acquisitions, IPOs, bond refinancing, all of that area of the market has been really muted for the past couple of years because of higher rates. As rates come in, we should see a lot of that pent-up activity increase, and the banks that provide like investment banking services and for both debt and equity financing, with banks with large or other institutions with large capital markets arms should really benefit from that, from what we anticipate is going to be a trend there. In 2024, we positioned client portfolios for the future in a variety of ways. We added exposure to defense companies as we see, geopolitical turmoil has continued to ramp up and very well may continue to ramp up in the future. We've been increasing exposure to growth companies across our portfolios, both in our fund strategies as well as the individual equity strategies. Within our BDC strategy, we've increased exposure to higher quality names. We've also introduced private commercial real estate lending MREIT names as we see dislocation driving opportunities in this specific area of the market. Within fixed income, we have been gaining exposure to more active managers with wider mandates, helping us extend duration and rely on those managers for more tactical positioning. We have maintained overweight position to high yield as we maintain our conviction on the resilience of the U.S. economy, helping our bond portfolios produce higher income and outperform. We've also maintained our lower exposure to international equities as we continue to believe in the excellence of the American economy. We continue to monitor the markets and economies, positioning our portfolios for the future.